Good morning and welcome to Bazaar Ki baat. We had another month of stellar performance from the Indian equity markets, with Nifty 50 clocking a 4.1% return and reaching its all-time highs. While the positive sentiment was widespread, the smaller companies did lag behind the larger peers. We saw the small cap index deliver a much more modest 2.4% return. After a long journey of negative returns, it was a positive month for the US markets as well. We saw the Nasdaq delivering around 6.6% return. Shitish, what do you think is happening in the market? What is your take on this kind of performance?
So I think, yeah, so if we just say, I think we saw a sharp recovery in October, and November was largely a month of consolidation. I think large performance, I think the significant driving force behind Sensex and Nifty was the FII inflow. We saw FII investments of close to 22,000 crores during this month. And while on the other hand, domestic investors kind of did a flip and they were on the selling side. So we have seen DIIs have been the driving force throughout this year. Almost 35,000 crore inflow every month from DIIs, but we have seen them slowing down and doing some profit booking after the month of June. So which has been the normal I would say characteristics of how DIIs and FIIs play out. Normally, DIIs will come in when market is at lower levels, and they will book profits as soon as we saw some rally. On the other hand, I think on the India equity markets, overall outperformance of on the global peers is largely on the back of strong corporate earnings and structural reforms, which now I think we are seeing some amount of positive outcomes playing out from the structural reform. We are seeing some amount of infrastructure companies doing very well. On the other hand, one thing which is very interesting is that the valuations, if we compare in terms of PE ratio, have become significantly lesser than last year. And the reason being, though we have seen some rise in prices, there's been substantial earnings growth within last year, which has actually pushed the PE ratio lower for Nifty 50 companies. Overall, what would be the driving factors for next month in December would be, I think there's obviously one factor which is governing the news is that there's some amount of Chinese unrest. China is the second largest economy in the world, and if anything, uncertainty is associated with that economy, we will see some amount of problems. And obviously, central bank actions will always be something which markets will track. For India specifically, oil prices is something we need to track. India imports almost 80% of its oil requirement, so oil becomes a very large part of our current account deficit. So that's one thing which we need to keep track. And obviously, there is global slowdown which is playing out, but India is largely cushioned due to the domestic earnings and credit growth which we are seeing. So overall, these are the 4 or 5 factors which we need to keep track in December. If everything goes well, I think we should continue on this journey.
Yeah. And I think the fact that India is cushioned is the reason FIIs are also pumping in money right now, even though DIIs are a little pessimistic on the way the markets will unfold. Coming to the sectoral analysis, Kshitij, we saw that metals and oil and gas were the best performing sectors, whereas utilities and power were the 2 laggards, even though both these sectors have had a very good journey so far in the current financial year. And IT, which had been a laggard so far, did see some kind of recovery. So what really happened in each of these sectors, which kind of delivered this kind of a performance, which looks very different from what we saw last month, actually?
Yeah, I think the main issue, or if we talk about sectors, is that metal and oil have actually had a uh, uh, got a thrashing last month because of the earnings and because the earnings were bad. Largely this month, the story is actually public sector companies. So they have made a strong comeback. And so largely we are seeing railway companies and state-run lenders like SBI or any of these Bank of Baroda. Have been particularly been in the news this month. Other gainers have belonged to infrastructure and related sectors. There also there is there is a large line share of that sector is public sector companies. So investors are now beginning to realize the implication of government's massive capex spending, of which obviously railways is the biggest beneficiary. And also on the other hand, PSUs have underperformed for last, I don't know how, maybe 15, 20 years. And now that the valuations have become so cheap, there's a lot of interest coming back. And because these sectors are largely infrastructure related or related to public goods, we are now seeing that cyclical upswing. And because of the stable economic times, they have become again come in favor of investors. So that's I think the largely the I would say sector wise, I would say the performance this month,
Right.
largely driven by public sector companies.
Right. You spoke about corporate earnings, right? So when we look at the quarter two corporate earnings for this financial year, it was kind of a mixed bag. We did see good top line growth, but the bottom line was kind of beaten because of the input cost pressures. We saw a very good performance by the BFSI segment. The 11 BFSI companies that form part of the BFSI equity index actually delivered 41% growth, whereas Nifty 50 was at a modest 2.8% if we take out the BFSI part, right? Earnings also, if we see that they were led by BFSI, automobile, telecom, and there were other companies which were kind of dragging down the overall earnings report, mostly from the metals, oil and gas, even cement, consumer durables. So what's your take on the way the corporate earnings are shaping up?
So I think largely, if we see, you have very beautifully portrayed the overall corporate earnings index wise. But if we go sector wise, I think the banking sector has given the best results. I think, and it's been giving for almost, I think, last 2 years, the banking sector results have been very good, largely on account of impressive credit growth and the rising interest rate scenario, though it sounds counterintuitive. The rising interest rates actually benefit banks, and there's obviously that significant improvement in asset quality which has played out. We saw Bajaj Finance, SBI, Axis Bank all gave stellar numbers this quarter. Second sector which continued its performance is auto sector. uh, all the auto manufacturers have actually increased their prices of entire portfolio. But the commodity prices have now started going down, so which has actually enabled earnings to grow sharply. Overall, Maruti Suzuki had given almost a 300% rise in net profit, so which is humongous for a company that size. And Eicher Motors, Mahindra, all of them have given good numbers. Overall, I would say coming to the top growers in Nifty 50, apart from these two sectors, Adani Enterprises, Coal India, Bharti Airtel, they've all given sharp rise in net profits in the range of 80 to 120%. As you said, metal sectors have actually had a challenging environment, largely on account of global commodity prices decline and that concern of global slowdown. Similarly, with oil and gas sectors, both of them are governed by the global commodity cycle. And if there is any fear of global slowdown, these two sectors are bound to I would say underperform. FMCG companies though witnessed a growth in revenue growth, which is largely driven by pricing. So they've increased their prices. But having said that, the volume growth for this sector has been negative for almost fourth consecutive quarter now. This, I believe, is largely due to the rural demand not picking up. There is that concern, continued concern that the rural India, actually the consumer demand is not picking up, which has been hampering the performance of this sector. Overall, if I would say, everything is, I think the management commentary, demand outlook, and recent cool off in key commodity prices, they've all made management so hopeful of margin recovery in the next half of the year. And I think I also believe that may play out with commodity prices cooling off. We might see sharp recovery in the earnings growth. And now that the revenue growth have actually been has already been high. So that's that's about it.
Yeah, so the other day we were just talking about how fundamentals are so important in how the stock prices deliver returns, and I think
Yeah.
we had a very classic show of that in the last month. So Kshitij has just spoken about how well the equity markets have been doing, reaching all-time highs. But I would like to bring in Vikas here. Vikas, there's another school of thought which is also talking about the fact that it's a good time to invest in debt funds. So what's your take on this?
Hey, hi, Shruti. So, yeah, being an equity investor myself, I also realize that equity is an asset class which generates high return. But I also believe that debt has its own place in an investor's portfolio. Given that we have seen RBI raise rates in the last 9 months by 190 basis points, the yields have become quite attractive. These yields are like in the range of 7.5%. And we also are not expecting that the rates will reverse immediately. But definitely, these are rates where you can lock in some portion of your fixed income investments. So this is my view that we are in an interest rate cycle which may not go up significantly from here. And these are rates where you should book some of your fixed income investments and lock in the rates.
So there's a lot of talk about a newer category of funds which have come in, which are called target maturity funds. We have been discussing this a lot internally as well. So what are these target maturity funds, and would you like to tell our viewers how do these really work?
Yeah, so see, I also invest in debt funds, and last 2, 3 years, my investments in debt funds have been significantly lower. Even I have not recommended like a lot of debt funds to our clients. The predominant reason was I was not finding it a very attractive investment instrument in comparison to FDs or other investment options which are available. But what has happened is that we have come up with certain products in the debt market where we are seeing the credit quality being very good. So target maturity funds are funds which invest in very high credit quality instruments like G-Secs, SDL, state development loans, and PSU bonds. What this gives investors is that they're not taking like credit risk. We have seen how credit risk played out in the last 3 years with the ILFS fiasco. So target maturity funds take care of the credit risk for investors and also help them lock in rates. So since these are fixed like maturity uh, debt funds, you can lock in your rates for 3 years, 4 years, 5 years, whatever is your investment tenor. So this kind of investment option gives the best of both the worlds, where you can invest in an instrument which is high, like which has high credit quality. Plus, you can also be certain about your rates. Plus, there's an added
So
advantage,
couple of
which is
yeah, please go
yeah,
on.
sorry. Yeah, so what I'm trying to say is that this is one advantage. Other than that, like since it's a fixed tenor plan, but with a premature withdrawal option. So this gives an added advantage to this kind of debt fund. So this is why we are strongly recommending target maturity funds to our clients.
So you just mentioned, that's what I was asking you. A few years back, we were saying that there was some interest towards FMPs, which were fixed maturity plans. So how are these target maturity funds different from FMPs that were the flavor of the season a couple of years back?
Yeah, so in 2017-18, whenever an investor wanted to lock in rates through a debt instrument, so they had to go to a fixed maturity plan, because in an open-ended mutual fund, if the rates rise or rate goes down, you cannot lock in your rates. So fixed maturity plan was serving that purpose for investors. But in a fixed maturity plan, the fund houses were also taking credit risk, point number one, even after, and also you cannot redeem your money prematurely. So that was one of the biggest disadvantage that an investor had. But with target maturity funds, these two problems of investors are getting solved. That they get to invest in an instrument. I'm reiterating that in a credit quality which is quite high, plus you have a premature option. If you do not premature and if you let it go for 3 to 4 years, you get an added advantage of tax. So we all know that debt funds are tax efficient compared to FDs. So you get best of both the worlds. So that is the best case for target maturity funds.
So a much better post-tax rate of return on debt funds as compared to FD, especially for people who are in higher tax brackets. So okay, so understood. All right, thank you, Vikas. We also came across another piece of news in the last month, and that was, as most of you would have heard, was around the FTX exchange. So FTX was one of the world's largest cryptocurrency exchanges, and it was based in Bahamas and was run by Mr. Sam Bankman-Fried. And on November 11th, this cryptocurrency exchange actually filed for bankruptcy, and the CEO, Mr. Fried, resigned. And this collapse, came after its rival and the world's largest crypto exchange, Binance, pulled out of a deal to acquire the company. So I would just like to understand from Kshitij. Kshitij, could you just unfold, what happened and what's the impact on investors because of this collapse?
So, FTX actually is a classic story of that age-old story of negligence, lack of internal controls, board oversight, misappropriation of customer deposits, and outright fraudulent corporate behavior. So the story at the beginning was that last year, the chief executive of Binance sold his stake in FTX back to Mr. Fried, who paid partially with FTT tokens. These are tokens basically issued by FTX, and on November 2nd, there's a crypto publication called CoinDesk who leaked out a document that there's a related party transaction with Alameda Research, which is also a company owned and run by Mr. Bankman-Fried, owning an unusually large amount of FTT tokens. So, and Alameda is in bit of a need for funds, and so Binance actually announced that on November 6th that they are going to now sell their FTT tokens, which they held after Mr. Fried paid with FTT tokens in last year to the Binance CEO. And post this FTT price collapse, and traders rushed out to pull out of FTX, fearing that there will be basically liquidity crunch on the exchange. And FTX initially scrambled to process these requests and eventually actually put down their shutter, saying that we cannot process any more withdrawal requests due to the liquidity crunch. This has actually caused a ripple effect across the crypto universe. Already, I would say it's a nascent crypto universe, and it caused a huge ripples. First of all, obviously, the savings of hundreds and thousands of customers who deposit their holdings on the FTX platform are in jeopardy. Secondly, there's a loss of trust in centralized exchanges. So there are two kinds of exchanges in crypto worlds. There is one centralized exchange, then there are decentralized exchanges. FTX and Binance are a kind of centralized exchange. Basically, an intermediary is involved between two parties. Thirdly, which is I would say which is bound to come, is that now regulations are going to come in on the crypto world. Already the Justice Department and SEC in USA have started conducting their search to see if there is actually an customer funds have been improperly used by Alameda Research, a trading firm which Mr. Bankman-Fried was running. And overall on the industry, there will be a huge fallout. We have already seen lenders such as BlockFi filing for bankruptcy. So, and we might continue to see few others going down that path. On the market front, on the crypto market front, of course, FTX has almost dropped 90% since November 8th. The price of Bitcoin and Ether have also come down almost 25%. But overall, I would say the long-term effects of this FTX collapse are yet to be known. if the regulations come in and then they are favor of it, it might actually help the industry to grow from something completely unregulated to an industry which is regulated and which may actually push that industry to the forefront or in the, I would say, to the proper channels of customer money. And while the or if there is actually a case of customer funds misappropriation and there may be a huge, I would say, clampdown on cryptocurrency, and which may go down, which may actually adversely impact this already nascent industry. So these two things may play out. How they play out in the future, it's yet to be seen. But my sense is that we might the exchange or the cryptocurrency world will will probably come out stronger out of this. I would say fraud or scam or event or whatever we call it, because regulations may actually uh, proper, I would say, make it a regulated industry, and it'll be a positive for the industry. That's my sense.
Yeah, I think that's how it happens for all nascent industries. And
Yeah.
so that's it from our side for November 2022. Stay tuned for Bazaar Ki Baat for December next month. Thank you.